Welcome to the Probate Nation. Whether you are caring for an elderly loved one as a court-appointed conservator or guardian, or as an agent named in an advanced medical directive or financial power of attorney, or just helping out without any of the above authorities, no doubt your primary goal in each instance is to provide your loved one with the best care possible. Often that care involves hiring and paying for caregivers in their home, or it may involve paying for that care in an assisted living facility or a nursing home. Getting good care for your loved one is important. Paying for it is the challenge. Many seniors have planned for this cost by purchasing long-term care insurance. This insurance, like any contract, has many nuances and terms that can be confusing. Having a baseline understanding of how the policy provisions works is important so you can ask the right questions and provide the necessary information when you make a call to initiate a claim for coverage. We are pleased to have as our guest tonight a long-term care insurance professional who will help us understand how this coverage works. Our guest has been actively involved in the long-term care industry for over 25 years. He built a long-term care planning department for an insurance brokerage firm and then spent 16 years with a long-term care insurance wholesaling firm, advising financial advisors, individual clients, and large employers on the importance of preparing for long-term care services. In 2016, he founded D. Hill Financial, LLC, an independent insurance agency. He's recognized in Washingtonian and Northern Virginia Magazine as a top insurance professional. Please welcome David Hillison.
Thanks, Richard.
David,
happy to be here.
Thanks for joining us today. Well, long-term care insurance, that's something that, can be a mystery to people sometimes. So tell me a little bit about what is long-term care insurance and what is it supposed to pay for?
Yeah, most people don't buy long-term care insurance multiple times in their lives. So they don't have a database of information to draw from to understand what exactly it does. Long-term care insurance is designed to cover the cost associated with ongoing services, whether that's in your own home or, as you described, in a nursing home or an assisted living facility setting. Health insurance helps us get better and covers what's called skilled care. Most long-term care is called custodial care, assistance with daily activities.
Okay, so what is the type of help then, to sort of expand, that is considered long-term care?
So long-term care is outlined and within the insurance policies, it's actually regulated by HIPAA, and qualification for benefits is outlined in one of two ways. Either our need for supervision because of cognitive impairment or senile dementia. Again, we recognize that we're not treating a condition there, but we do need some supervision. And then there's a physical definition as well, and that's outlined based upon daily activities, things we do every day, like bathing, dressing, getting up and going to the bathroom. If we needed help with 2 out of 6 of those activities, that would be a qualifier for benefits under a long-term care policy, and those are the types of services that long-term care insurance is designed to cover.
Okay. Well, I know long-term care insurance has taken many different forms over the years, and that has evolved. I know even since I bought long-term care insurance myself over a decade ago. So let's just talk about some of those different variations that people may be confronted with, because many of the people that are going to be facing this are going to be not so much the people who bought the policy, but that guardian or conservator or power of attorney person or family member who's actually going to have to take that policy and make it work for their loved one. So what is traditional long-term care insurance?
Well, the original policy design was nursing home only. We bought a policy and it covered the cost of going into a nursing home. Over time, insurance companies saw that they could deliver a similar type of service at home. And at home, there may be some savings. We're in a facility, we know we're there every day. And then over time, you started to see assisted living facilities and other types of providers available in the market. And some insurance policies have changed over time to allow new types of providers. Others, you have to go and see what the contract says and understand what types of providers may be covered by that plan.
So yeah, it's key to understand that. So how about, I know some life insurance policies now will actually allow you to add a long-term care rider. And that's something that I think is new.
It is.
Several years. Tell me a little bit about that.
And that developed based upon changes in tax law that made that more possible, and also by the changing in the marketplace in general. So we're seeing fewer companies offering traditional long-term care insurance today. but there are a lot of life insurance companies in the market. And so life insurance companies have started to offer options where you can get access to some of the life insurance in the event of needing long-term care service.
Interesting.
The reason that people like that is twofold. One of the reasons that people don't buy long-term care insurance is they don't want to use it, right? So what if I never need it? A life insurance, we know at some point, is going to pay off. And secondly, we know that rates under life insurance tend to be fixed and guaranteed. And long-term care insurance, while in general we've seen some rate changes in the marketplace, there are also a number of companies that have never changed rates, but people like certainty, and that's what life insurance gives us.
Okay. Okay. Are there any downsides to the life insurance policy as being the vehicle by which you capture your long-term care protection?
Well, a long-term care insurance policy is going to be the most economical way to pay for care. All right, so what does that mean? That means life insurance is generally going to be more expensive. We're not buying a term insurance policy that we have for 10 or 15 years. We're going to want a life insurance policy that we carry for the rest of our life. And with that, there's a certain expense that goes along with buying permanent life insurance.
So that policy has cash value as opposed to the term policy would not?
It doesn't have to.
Oh,
all right.
really?
So there are a lot of different types of permanent life insurance. Some of them have cash value, some do not. Some may offer strictly a guarantee of the rate and a guarantee of the death benefit. And while having cash value may be attractive, we're also buying a plan to cover the cost of long-term care services.
Okay.
So having access to the cash may work against what we really need that benefit for, which is to cover ongoing medical services at some point in the future.
Okay. Well, let's talk about long-term care as a rider to an annuity.
Sure.
That's something else I see that's now in the marketplace.
Sure. Another form of hybrid. The term hybrid is, combining multiple types of solutions together, and annuities are another form of hybrid where insurance companies understand that there's interest and value in having a long-term care component, and so if they can bring this to one of their mainstream products, it makes them more attractive. The downside is that when you're adding expenses onto a plan that's usually assessed based upon the returns of the plan, you're going to draw down some of those returns, to be able to give this additional benefit. But the real value of having annuities is the fact that someone that may have some medical problems may not be able to qualify for a long-term care policy. They may not be able to qualify for a life insurance policy where maybe they could buy an annuity based upon their age. That not only pays out the annuity benefit, but can give you a step up in basis if you needed long-term care services at some point in the future.
Well, that's very interesting. So that's a nice little tool, depending upon the health condition of the person, to allow them to get that kind of coverage. Now, you mentioned that when we were preparing for this show, we talked about a hybrid long-term care that has a linked benefit. Explain that.
The term linked benefit is a category of hybrid plan where the focus is still on long-term care. So we describe life insurance that may have an option that accelerates the benefit for long-term care, but once we've used up the life insurance, there's no more policy. A linked benefit actually has some life insurance, the same underlying rate guarantees, but then can have a richer component associated with long-term care or for long-term care. So that could be a benefit that pays out forever. And those are still options available on that type of plan that may not be offered in the traditional market, and certainly we don't buy an unlimited bucket of life insurance to draw from.
Sure.
So it just gives us, the nice part is that we have more options, but they're all good. There's not one that I look at and say that's the right solution. Very often with a client, we're looking at 2 or 3 of those variations, and based upon their preferences and budget, we're able to design a plan that's right for them.
Okay. Let's talk about some of the common features of long-term care insurance.
Sure.
So, deductibles and waiting periods.
Yep. So long-term care policies really have 4 moving parts. One is the maximum amount the plan will pay, up to what policy limit. And the one you just described is when will benefits kick in? When will they start? And the typical deductible in a long-term care plan is typically stated based upon days as opposed to a dollar figure.
Okay.
So very common is to have a deductible that's 90 to 100 days because Medicare or health insurance may play a role for that 100-day period treating skilled care, not custodial. But because we know there may be some source of funds from Medicare or health insurance, very often we'll have a 90-day deductible on a long-term care policy to work around that.
Okay.
The deductible themselves aren't necessarily straightforward.
Okay.
You know,
So it's really, it is in terms of days is more than anything else. Now, if somebody actually needs care in their home, do they find that those days those waiting periods are waived?
It depends.
Depends.
So some insurance companies will have no waiting period at home. Some will give you the option to have no waiting period at home where you can pay a little bit more in the plan to have that option. The deductible may be counted based upon the number of days where you have someone in treating you. That's called a service day definition. Sometimes it's a calendar day definition where you simply met the 2 out of 6 activity definition or cognitive impairment definition. Mm-hmm. They may be starting the clock even if you have family members stepping in to provide the care. And again, this is all outlined in the policy, and the better the language, the easier it is to satisfy that deductible. So calendar day would be better than service day, and obviously having no waiting period for home care, again, just it is easier then to start receiving benefits. And if we bought the policy, the one thing we want is to start getting the benefits.
Sure, sure. Let's talk about the claims process. What is the claim process as we begin to go through some of these various plans? So we're talking about the traditional plan versus the annuity plan versus the life insurance with the rider versus the hybrid linked long-term care plan. Tell a little bit about the claims process.
And I don't think that the claims process is going to vary, between the type of plan you purchased. Mm-hmm. But just understand that we're still dealing with a contract, right? The contract reads very normally to me, but does it to the person that's reading it, or maybe someone else stepping in down, at some point down the road. There is a claim section, and the claim section says not only the process, but the timeliness of response. So when we reach out to the insurance company, there's typically someone there to do an initial assessment intake. Is this really, is it going to be a claim? Sometimes we don't know the triggers, sometimes we don't know the types of providers. And so the person there is, trying to understand whether we're going to have a claim. Mm-hmm. And if there is a claim, they will generally send out a form that gets to the doctor or licensed healthcare practitioner to actually certify that there's a need.
Okay.
The care provider that'll outline the types of services that they're going to be performing, and one that the individual completes themselves.
Okay.
But I will say that the claims process in long-term care, it works. And the reason it works is because we're either inviting someone into our home or we're going into a new setting. And again, with that in mind, we recognize that there is a need. And the question simply is, how do we work through the process to make sure that we have access to the benefit?
So let's talk a little bit about care coordination.
Sure.
Okay, what does that mean?
Care coordination is a service in a lot of the plans where they will help assess providers in a given area based upon the individual's need and make recommendations based upon the need, the types of services, maybe the type of provider that may be appropriate. Mm-hmm. Doctors generally are not in a position to know who the provider network is in the area. And so social workers, registered nurses typically are in that role of acting as a care coordinator. Mm-hmm. Some of the insurance companies have their own care coordination service. Some will allow an independent provider. We have found that both work very well. Mm-hmm. The advantage of having a carrier representative is you know exactly who to go to. You're not asked to go find someone else in the community. And the advantage of having the option to hire your own is that you truly feel like they're working for you. But I will say from our experience that both have worked very well without any prejudice of one direction or another.
Okay. Well, let's talk about, can family members be paid under these various policies to provide the care at home?
So one of the things to always look at in an insurance policy is what's not covered, right? That's where you always start. All right, what's not covered? You've already told me what is covered. Now tell me what's not covered. And very often, care where there's normally no charge wouldn't be covered. Family members may fall into that category. There may also be a specific exclusion for family members. However, there are plans that allow it, and they'll allow it either based upon how the benefit is paid, and we can talk more about that. But they may also have provisions within the policy that say if you are a nurse and you are aligned with an agency and you're working in the same capacity as anyone else, that we would pay you as a qualified provider. So recognize that we often buy long-term care insurance to take the responsibility off of family members. But in the right circumstances, if that was desired, there are at least provisions in some of the plans. The carriers that have had allowance for family members aren't necessarily allowing that in new policies today. So we need to look at a plan today that may be paid out the benefit as cash as opposed to reimbursing a qualified provider. And that's just one of the ways that benefits are paid.
Okay. Let's talk about reimbursement policies. What do we mean by that?
Yeah, that's exactly what I was referring to. There are three ways that benefits get paid from the plan, either as a reimbursement of an actual expense, which you just described, as an indemnity payout where they pay a flat amount for qualified caregivers, or as cash. And if it's paid as cash, you obviously can then use that to hire a family member. Again, where the indemnity or the cash may seem attractive, we also have people that deal with elder abuse, right? And so, because in most cases we're not buying an unlimited bucket of money. I said there are options there, but we're not going to live forever, and that's really more insurance than we can utilize. So, if we do have a finite bucket to draw from, we want that there for our needs. And so reimbursement is a model that works fine. That's how the majority of the plans, you incur $2,500 of expense in a month, you submit the bill, and the $2,500 gets drawn from the policy to cover that expense. So reimbursement works very well. In most cases, people are gonna have less insurance than what they actually plan to use. Meaning, if the cost of care in our area is $300 a day, sometimes you have $300, but maybe you have $150, maybe you have $200. And so it probably won't matter whether it's reimbursement or indemnity or cash if we're going to be using the full benefit anyway.
Okay. Now, if there's a plan of care, does that need to be reviewed periodically?
So through the claim, they'll not only review the provider, but then outline the types of services that's going to be provided. And the plan of care is what reviews those services, that outlines those services. So if we believe that you're going to need 4 hours a day of service, and that over time that graduates to 8, but the plan of care doesn't get updated, the insurance company expects that they're going to see a bill for 4. So it is important that we keep the plan of care up to date, and by law it's required to be reviewed at least once a year. And when I say by law, that goes right back into HIPAA and tax qualification.
Okay.
But there was something else that relates to that as well, and that is partnership certification. So Virginia is a state, Maryland as well, that allows for partnership provision within private long-term care insurance and unique access to the Medicaid program.
Okay.
So if you have a plan that follows HIPAA, that is tax qualified, now as that policy pays out benefits, if it has an inflation protection appropriate for your age, and this is outlined by the program, that as it pays out benefits to you, it turns countable assets into non-countable assets if you went to the state to ask for help.
Oh, interesting.
So the reason they do that is to try to encourage people to take personal ownership themselves. What they have found is that if you own a long-term care policy, you're less likely to end up relying on the state for help.
Well, that's probably a good idea.
Yeah.
Encourage that. Well, let's talk briefly. Will a long-term care company talk to anybody?
They won't.
So
they will talk.
So I'm trying to help out my dad, and I pick up the phone and call the long-term care company.
They can't tell you.
They can't tell me anything.
Right. The HIPAA, outlines privacy, and the best way to do that is twofold. One, have a HIPAA authorization signed. That is only good for 1 year, right? So you may need to renew that, send it to the insurance company. But it is just as easy to get on a joint call together.
Okay.
Pick up the phone. My father's here. We think we may need to exercise the policy. Can you answer a couple questions for us? Sir, is it okay? Does he have authorization? Yes, and you can.
Then you're
handle the
good.
call
You're
that
good to
way.
go.
Yeah, absolutely.
So one of the things that I know that people have been concerned about, and we've seen it with some of our clients as well, is these long-term care companies come in and sell a policy inexpensively, and then premiums start to jump after a couple of years, or they go out of business. So talk a little bit about what happens when a long-term care carrier goes insolvent.
So we've seen a lot of changes in the long-term care marketplace. Most companies that were in long-term care insurance stopped writing long-term care insurance, but all but one of them is still in business. They're just in business selling life insurance, investments, other products. Maybe it was a company that focused more on disability, and so they went back to disability and they're not writing long-term care anymore.
Okay.
But there's still a contract that is guaranteed renewable for life, which means as long as you're paying your premium, the company can't change the provisions and they can't take it away from you. That acts as a certain level of confidence for us that we know as long as the carrier was financially strong to begin with, that hasn't changed. They've just philosophically decided they don't want to sell long-term care insurance anymore. There is one company that wasn't as highly rated, never was. To your point, rates were below where they should have been, and they accepted people that other carriers would not. Those two things don't usually go well together. And they were never highly rated. And that's the unfortunate piece, is that because we don't buy long-term care insurance multiple times in our lives, if someone says, hey, this is a good plan for you, we don't know how to balance that, and we trust the person that is there to help us. That company is still paying claims. They are in rehabilitation with the Commonwealth of Pennsylvania, and they're still working to see how they can bring that to a stronger financial position. However, claims are still being paid, and we may find that there is a reduction in benefit, but that hasn't happened to date.
Okay. Well, a lot of people, as you mentioned, you pay, one of the reasons people go to things other than straight long-term care is that they have nothing to show for it if they never use it. So,
right.
But there is a vehicle in some cases, to actually surrender your long-term care policy. Talk a little bit about that, would you, please?
Yeah, so one of the main concerns people have is that they'll get priced out of the policy. Right now, we've seen some increases in long-term care insurance. There are a lot of companies still where the rates have remained stable. There's an option that people can purchase when they buy the policy called non-forfeiture.
Okay.
And if you bought that option after a couple of years, maybe 3 or 5, depending on your state, you can cancel the policy and still have access to what you've paid into the plan as a reduced paid up benefit. So instead of a plan that was going to pay $300,000, you've paid in $40,000, and you say, look, I'm done. You can bank what you've paid in. But there's a provision called contingent non-forfeiture, which is a form of consumer protection against rate increase. And what contingent non-forfeiture says is if the company were to significantly change the rate, and it's a table that's standardized in the industry, it's not carrier to carrier, at a time of rate increase, they'd be contractually required to give you the option to exercise that. Okay. So again, does it make sense to pay the increase? I've had an increase on my policy. I paid it. Policies today are more expensive, but it at least does give you some comfort to know that if I had been paying in for 40 years and I had accumulated a lot in there, that it gives me some options down the road. Okay.
Well, we've covered a lot of stuff here, and we don't have a lot of time left, but I wanted to ask you to give me some of your, a final point or two you want to really share with our audience that you want to stress about long-term care insurance and how it's to be used to help, pay for some of these long-term care costs.
Yeah, well, it was interesting for me to hear that you own a long-term care policy as well. So when I bought my long-term care policy, I had just turned 40. I know that is younger than typical, but it was something that was important to me. And what I found was that when I bought life insurance, my wife slept better at night. Me, not so much. But when it came to long-term care, it was a personal feeling that I knew it was really something for me. So I think that's an important element. We want to take the burden off of those around us that care about us, but it's really something to make sure that my needs are going to be taken care of no matter what life throws at me down the road.
Yeah, that's really good. That's a good comment. David, I want to thank you so very much for taking the time to come in and talk with us and to share this great information. It's a great public service to the folks across Northern Virginia.
Thank you, Richard.
Thanks for coming
Wishing
in.
you all the best of health.
Thank you, too.
Thanks.
The cost of providing long-term care for a loved one, whether at home or in a retirement facility, can wipe out a lifetime of savings. Long-term care insurance shifts some of all of that cost to an insurance company, and in the process, serves to protect those savings. I often refer to this insurance as fire insurance for those savings. Our guest tonight provided great insight into what long-term care insurance covers, how it is claimed, when it is paid, and to whom, and who can provide the care that is covered by the policy. Keep in mind that long-term care insurance is a contract, and contracts can be complicated and confusing. If you're caring for a loved one and they have a long-term care policy that you want to make a claim on, you may find it helpful to sit down with an experienced insurance professional who can guide you through the thicket of policy terms. Such advice may prove especially beneficial before you initiate a claim, so I encourage that conversation. This brings us to the conclusion of our show this evening. Hope you found it informative. And remember that replays of the show can be viewed on the Probate Nation website. On behalf of the Probate Nation, thank you for visiting with us.